Oh boy. Oh boy.
So good morning everyone. My name is Marivic Español and I am from BSBA 2B. So I am here to discuss about financial management and of course to discuss what really is the primary goal of a financial management. But for me to do that and to be able to discuss about it, I prepare a video presentation. In this video presentation, it contains 5 trivia questions. This is for you to test if you have knowledge about financial management and its primary goal. And at the end of the video, you'll be able to know if your answer is correct or not. So if you're ready, let's start.
Good day, Mom. Good day, classmates. Financial management. Stocks and bonds function. What is a stock? A type of investment that gives you part ownership of a company, a claim to a company's assets, and earning that often give investors voting right and pay dividend. But if the corporation prosper, the investor prosper. If the corporation fails, the investor can lose his investment. Generally speaking, the higher the potential return, the higher the risk. What is bond? Bond is an instrument used by governments and companies to raise money by borrowing from investors. Think of them like loans. Stocks and bonds, the two basic building blocks of investing. When it comes to investing, we have two options. We can be owners and we can be lenders. Let us say there are a small independent milk tea shop. The owner decided that he needed the money so that he can open the second store, and he have two options. Option number 1. If you give him $100,000, he will give you half of this company. You will have owned 50% in the company. The word of investing ownership is known equity. each have one equal share, 50% for owner and 50% for investors. But it is possible that you have 5 investors of $100,000 who will buy 10% of the company, and the owners dividend 10 equal shares, and each value $20,000 for sure. Option number 2. If lend him $100,000, will pay you back after 10 years. Pay you interest 4% per year. 4% times $100,000 equals $4,000. If you lend the owner $100,000, and every year he proposing that will give you fixed payment, after 10 years will back to you the original principal of $100,000, and you really just cold loan or debt. The importance of stocks and bonds in the financing business and public project. First, to help major businesses and government to raise capital for the investment project, business expansion, and strategic infrastructure. To revive the economy in terms of developing jobs and contributing growth and domestic project.
You can analyze the major financial ratios. Financial ratios created with the use of numerical values taken from financial statement to gain meaningful information about a company. The balance sheet, income statement, and cash flow statement are used to perform qualitative analysis and assess a company's liquidity, leverage, growth, margins, profitability, rates of return, valuation, and more. Financial ratios are grouped into the following categories. First is liquidity ratio, leverage ratios, efficiency ratios, profitability ratios, and market values ratio. First is liquidity ratios. Liquidity ratios are financial ratios that measure company's ability to repay both short and long-term obligations. Common liquidity ratio includes the current ratio, asset test ratio, cash ratios, and operating cash flow ratio. Current ratio. Current ratio measures the company's ability to pay off short-term liabilities with current assets. Current ratio is equals to current assets all over current liability. Next is asset test ratio or the quick ratio. Measures the company's ability to pay off short-term liabilities with quick assets. Asset test ratio is equals to current assets minus inventories all over current liabilities. The third one is the cash ratio. Cash ratio measures company's ability to pay off short-term liabilities with cash and cash equivalent. Cash ratio is equals to cash and cash equivalents all over current liabilities. And the last one is the operating cash flow ratio. Measures of the number of times a company can pay off a current liabilities with the cash generated in a given period of time. Operating cash flow ratio is equals to operating cash flow all over current liabilities. So the second one is leverage financial ratio. Leverage financial ratio measures the amount of capital that comes from debt. In other words, leverage financial ratios are used to evaluate company's debt level. It includes the debt ratio, debt to equity ratio, interest coverage ratio, and debt service coverage ratio. So the first one is debt ratio. Measures the relative amount of company's assets to the provided from debt. So debt ratio is equal to total liabilities minus all over total assets. So the second one is debt to equity. It calculates the weight of the total debt and financial liabilities against the shareholders' equity. Debt to equity ratio is equals to total liabilities all over shareholders' equity. So the third one is the interest coverage ratio. It shows how easily the company can pay its interest expenses. So interest coverage ratio is equals to operating income all over interest expenses. So the last one is the debt service coverage ratio. It reveals how easily a company can pay its debt obligation. So debt service coverage ratio is equals to operating income all over total debt service.
So hi guys, my name is Neil Ilagan and I'm from BSBA2B and I'm here in front of you to discuss the efficiency ratio, the profitability ratio, and the market value ratio. So first, what is efficiency ratio? With a few expansions, the efficiency ratio displayed to the cost as a percentage of income. Basically, how much a business or entity spends will make a dollar. Companies should aim to reduce efficiency ratios, usually the notion of known to banks. So in efficient ratio, there is 6 types. The first one is the account receivable turnover, working capital ratio, asset turnover ratio, total asset turnover ratio, inventory turnover, and day sales in inventory. So this is the formulas when you get the efficiency ratio. So first, when you need to know the inventory turnover ratio, the formula in inventory turnover ratio is COGS divided by the inventory. Then, get the fixed asset turnover equals to revenue divided by total fixed assets. Then, asset turnover ratio, revenues over total assets. So, receivable turnover ratio is equals to credit sales divided by account receivable. So, when you're done with it, let's go to account payables turnover, and its formula is the total purchases over the average account payables. So now, let's tackle about profitability ratio. So first, what is profitability ratio? The profitability ratio is the relative magnitude of two chosen numerical values taken from the financial statement of an enterprise is a financial ratio or accounting ratio. There are several common ratios commonly used in accounting to try to determine the overall of the financial position of the company and or the other entity. So in profitability ratios have 5 types. So the first one is the gross profit ratio, the operating ratio, the operating profit ratio, the net profit ratio, and the return on investment. So this is the formulas how to get the profitability ratios. So first, you need to know the formula of gross profit margin is equals to gross profit divided by sales times 100. The second one is the operating profit margin, operating profit over sales times 100. So the third one is the net profit margin is equals to net income over sales times 100. And the fourth one is the return on assets is equals to net income over assets times 100. So when you get all, let's go with the return on equity, net income over shareholders equity. So the last one is the market value ratio. So what is market value ratio? Market value ratio is the current share price of the publicly held company stock. To calculate the current share price of the stock of publicly traded firm, market value ratios are used. So calculated as the cumulative dividends paid annually divided by the stock's market price. If they were to acquire the stock at the current market price, this is the return of the investment for the investor per share profits. So to get the market value ratio, there is 2 formula. The first one is the market capitalization over book value. And the second one is the price per share over book value per share.